Here's what's coming up on today's show.
But if you buy a piece of property, it sits on the ground and you don't improve it and you've borrowed money, you're just paying a payment instead of having positive cash flow.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
Let's talk about extra houses. Let's talk about rental property, okay? As a realist, obviously, this is something you guys have experience in. What's your thoughts on these kind of items, and do you incorporate them or help your clients with things like this first topic?
Well, I think in our experience when we're sitting down with our clients and our prospective clients, usually people get into real estate when they're young, right? They've got the physical build and the time, and there's like, I'm gonna buy a piece of real estate and try to flip it or own it and rent it or do whatever. And then as they get older, they decide, do I really want this property anymore? Because they've had the phone calls at 5 o'clock on a Friday, and the person says that, the plumbing needs to be fixed. And you're like, well, why didn't you call me earlier? You knew about it. You'd said on Monday. Why are we waiting until Friday and having, time and a half hours on the plumber? Yeah. So they really think about, do I really want to keep that? I guess taking a step back, in your investment portfolio, real estate is a segment of that portfolio you should be investing in, whether you're actively investing it in real estate or whether you're investing in it in a portion of your portfolio as a passive investment. So we're proponents of having some aspect of your portfolio in real estate. How do you do that? So really on the rental property, when you've got it, you've got to decide at some point, do you really want to remain as an active landlord? Are you going to be getting the phone calls? Are you going to be making the repairs? What do you want to do with this piece of property? There may be a time that you decide, I don't want to do that. So what do I do then with this property? How do I turn it into additional income producing property but not be hit by taxes? Right, Craig?
May I? Mm-hmm. So she's dancing around this. We had rent houses. We had several of them. And the person that's talking, my life was go to work Monday through Friday and then go to soccer games and fix rent houses on the weekend, because that was every weekend there was something to fix, something broke, somebody needs something.
Sure.
I can't begin to tell you some of the funny calls that we had. We had somebody break into a house and tear the front door off of it on Christmas Eve, this poor family, and I had to go and put a door in there and watch them say, I don't have any stuff for my kids. It was terrible. But there was a day when I woke up and I said, I just don't want this life anymore. I've been a landlord. They paid me rental income. I was happy with what I received. It's the work and the time that it took. And I just did not want to be a landlord anymore.
I imagine it's exhausting sometimes.
Well, you don't think about it when you're doing it.
Okay, sure.
But when you take a step back from it and go, there's more to life than waiting for the phone to ring and going every weekend with a couple of folks and trying to fix them. So that day arrives and you say, I am going to sell this property. We did. We sold several rental properties in one fell swoop in 2020, but we're in this industry, so we knew what was coming. If you are just thinking, I'll sell it, maybe there's a little tax on the gain. No, there's a lot more to that than just selling a piece of real estate and having maybe a long-term capital gain. So Jennifer, talk to us a little bit about what's probably going to impact that investment property sale.
Sure. So when you have investment property, we're just going to go through an example. Let's assume that you purchase this property or properties for, I'm going to say $750,000. And you've had the property for a while, you've depreciated it over the years, and you've got about $500,000 of depreciation. Well, that means your adjusted cost basis is now $250,000. Well, market's gone up, right? So the sale price of your $750,000 property is now $1.75 million. So you made $1 million on the property, right? So you have got a total taxable gain of $1.5 million. Adjusted cost basis of $250,000, sale price $1,750,000. So you've got that taxable gain of $1,500,000. Well, the government says, you've been doing the depreciation and taking that as an expense year over year. We want some of that money back. So let's assume that, from that depreciation, you've got to take 25% and reclaim that. So that's another $125,000 there. You've got the federal long-term capital gains tax of right here in this example, 20%. So that's $200,000. Potentially a sales tax. And in this example, they were using a pretty high sales tax of 13.3%, but almost $200,000 there. Then you've got potentially the 3.8% tax for net investment income tax, which is another tax that the government throws out at you. So all those things back in taxes due is basically $581,000 in taxes. So you thought you had a gain of 1.5, but then you've got a tax event of $581,000.
So you're sitting there going, I bought that property, I kept it up, I paid property taxes every single year, and now at the end, who gets to share a lot of our revenue? The federal and state governments. It doesn't feel fair. So let's say, for example, that we like the idea of income for real estate, but we don't want to be a landlord and involved in the day-to-day activities because of, first of all, there's a lot to do. And secondly, there's the unknowns and just the problem of owning it and dealing with it every day.
Well, there is an ability to basically take an investment property and say, I want to go ahead and turn it into another investment property. And you basically use something that the IRS has coined a 1031. It's under the code of 1031, where you take one investment property, put it into another investment property, and you basically kick that tax obligation down the line. So instead of having to have a taxable event, in this case of $581,000, you say, I'm going to take one property, put it into another property, and now on that new property, I'm moving that gain forward, basically. And the hope is that you continue to move that gain forward for a better tax outcome, or you can potentially pass away and totally eliminate the gain for those heirs. So you can really manage your tax line a lot better by doing those 1031s. Now, there's ways you could mess it up too, right, Craig? You've got to do things in the right way to do a 1031. Then there's a special provision called the DST 1031, which is really, I think, the ultimate for a lot of older people when they want to get out of the day-to-day. And a DST 1031 basically allows you to buy ownership in commercial grade property, and you're basically buying a triple net lease income flow.
So bottom line here is, before you sell an investment piece of real estate, let's sit down with your CPA. Yeah, I think you should have us involved because we have done a lot of these both for clients and for ourselves. And let's go through the numbers. How much will it cost me off of my top line revenue for taxes, for real estate agent cost, and just understand this is what the top line is. How much do
net
I
Moser.
get to keep? Yeah, net Moser,
net client.
you. And then if you want to do an exchange of your property into another, Jennifer said it, so let's talk a little bit about it. Triple net lease. What that means is I don't pay any property taxes, I don't pay any insurance, and the upkeep of the property is on the tenant. So now what's the deal? I'm the owner, and they keep it up and pay the taxes, what have you, and I get a check every month. So that's where we are now with our real estate, mostly because I just don't have time to do it. It's very nice to open up my fictitious mailbox. We actually have it electronically sent to us, but every month we get a check. And I don't have to go out and take care of things like I did before. So it's a very nice thing. So if you do that type of exchange, either you're going to do it into another piece of property that you selected, or maybe somebody like a commercial real estate person selected for you. You swap into it. There's some steps in here, so don't do this at home. And then the other part is, if you want to use something that Jennifer mentioned, a Delaware statutory trust, we would be the type of people that you would talk to help source the different properties that you could potentially move into and allow you to be able to see those.
Where would we go next? Home equity line of credit, maybe?
Real quick before we start,
Okay.
and the king of real estate was Craig's dad. And this is the weekend before he turns 97. So a shout out to Maurice Moser.
That's awesome.
Turning 97.
Man, that's amazing.
Unbelievable.
So
Huh?
he drug Craig to many a real estate.
He had 4 sons, so he had free labor. Trust me when I tell you, he used it too.
So let's talk about home equity.
Yeah.
So there are 2 different ways to access the value of your house.
Okay.
I hear it all the time. Your home is probably your largest single investment, and it could be. You could have a piece of real estate or several pieces, well, mostly your primary home, and you say, okay, I've got this big honking house and I need some money. What are you going to do? Sell a bedroom? I mean, you can't really do that. You might sell the whole house, but if you're looking at your piece of property and you're looking at how do I pay for my future income, you might look at that house. Now, there are 2 different tools that are usually used here. One of them is called a home equity line. So what that is you go to a bank and say, I have this asset, whether you have a mortgage on it or not, and they will tell you how much they would provide as a line of credit against that house. Very simple. If you start pulling money out of that home equity line, you will also create a payment. You see what I'm saying? So it's not like you just borrow and don't have to make a repayment schedule. There is one, and it'll be based on what the terms of your HELOC is. Or you can do something called a reverse mortgage. Now, people frown and go, I will never do that. Have you ever actually researched what a reverse mortgage is? We don't do them. We don't offer them. So I'm just talking to you about it. In the home equity line version, you have to make payments back. So yes, I can borrow against the value of my house. The bank will give me money for that. But next month, they expect me to start a repayment schedule. Mm-hmm. It'll be interest and principal. It's a shorter time frame. I think it's 5 years, isn't it? I could be wrong on that. But they want that money back.
It's usually variable. It's usually tied to prime or another indice, plus or minus, depending upon your credit.
Right. So the other version is a reverse mortgage. So not every place offers a reverse mortgage, but you go in and you say, okay, you appraise my house, and then you give me a line of credit. I can either use that line of credit ongoing now. You could probably buy the entire balance. We'll have to get somebody on the radio show that does just that product. But basically, you're saying, I'm going to borrow against the value of my house up to a certain amount. So they predetermine that. You can let that thing sit dormant. You don't pay anything other than the origination cost, to get the loan in there. But once you start borrowing, there's no repayment schedule. And you go, I don't get it. Well, they're set up to where they're going to lend you that money. And it's against the value of your piece of real estate. They're not typically going to lose money. They know how to do this. And they'll let you borrow up to that maximum amount. Then you would have to stop. When you pass away, that line of credit is against that piece of real estate. They have a window of time, and it's not 10 days or something. I mean, they give your people that inherit that real estate enough time to sell it or pay off that line of credit which you used, but you actually activated the value of your home to a certain percentage. So don't just close your mind to it. I don't have a dog in the hunt here, but I'm just telling you that when you're looking at sources of income and you might be coming up short, you may want to discuss a reverse mortgage with someone.
And you didn't talk, the reverse mortgage does also have an interest rate. So, you borrow a certain amount, but then behind the scenes, it is accumulating interest and decreasing the amount that would be left to heirs. So, but you're not having to actively make that payment back.
Okay. So then, let's say that, Jennifer at the beginning of the show said, we believe that you should own real estate in your portfolio. Maybe you don't have enough money yet to go out and buy the commercial warehouse. Okay. I'm understanding that. But, you can buy this through things called real estate investment trust. It's a passive investment. Yes, there will be a little bit of a tax break. There will be cash flow from the rental income typically. So there are a lot of companies out there that provide those for you. So you can do a REIT or something called an exchange fund that would allow you to be able to have access with someone else managing it and it's real estate. So let's make sure we understand what we're doing. Typically with a REIT, you're buying a basket of real estate, income, but it may not be liquid. A lot of times, at least on the older real estate investment trust, you're in it for a while. Okay, and there's not really a liquidity event. In the interval funds, there are.
And we've had several clients that have come over to us and, brought their portfolio to us, and they do have those illiquid REITs. And it's interesting. I think we've had a client that was at least 10 years ago that did this, and they're asking us, how can I get out of this thing? Get me out, get me out. We're like, oh my gosh, we didn't get you in.
Yeah, we can't get them out. Not without a lot of pain. So,
right.
Yeah. So anyway, rental property, home equity line, reverse mortgage, real estate investment trust. And a lot of people are asking us, I want to make some money. I had some friends that made money flipping houses.
And I tell you what, TV makes it look, fun and sexy and easy and always making money. I've never seen one of these shows where we lost our butt.
Have you ever seen those funny memes too? It's always hilarious. It's like they'll have people on that'll say, she's like, I make, macaroni art and my husband's an underwater basket weaver and our budget is $1.7 million. It'll be something crazy. It's like
yeah, exactly. So there's TV and there's reality, right?
Right.
So it's not as easy as it seems, or as they try to depict it. So in reality, really it's location, market,
and price. Price.
Right. What you buy it for, because that determines basically any type of a gain you might have, right? If you buy it too high and you put more money into it, you ain't going to make money, right? So, but you also have to think about, all right, so you've got this house. What is your skill set? Is your skill set in decorating? Is your skill set in reframing and roofing and all this? Or do you have to have a crew of people? And then to have that crew of people, I tell you, in this market, you might wait 6 months to get someone to even come out and look at something before they can even get there.
Unless you already have the crew, of course. Yeah.
So you need to think about, are you doing a one-off? Is this some of the stuff you can do? Do you know where to go for that expertise? And then start looking at the cost of that, because they want to make money too on these jobs, right? And then you need to look at, kind of, again, your expertise and what you're going to be adding to it. Are you going to be borrowing money? Then you've got the carrying costs of that. You borrow it now. How long is it going to take you to wrap this project up and potentially sell it? Are you going to sell it yourself, or are you going to get a real estate agent? So then you got to factor in that cost as well. So we had fun. Oh, we love real estate. We had fun flipping a house. We've done one flip, and that was great. You got to think about, too, when you do flip that house, are you going to basically buy it and sell it within a 365-day period? And that means it would be a short-term capital gain for you.
Just taxed as income.
Gotcha.
Or are you going to hold it at one extra day and it'll be then converted to long-term capital gain? Just to give you some perspective, as you're listening, short-term capital gain. If you if you're married filing jointly and you're in the $96,000 to $206,000 income level, it's going to be 22% if it's short-term. So whatever you make, you're going to give the government 22%, and then depending upon how much you gain it was, or you're going to have subject to other taxation. If you wait that extra day and have a long-term, basically, if you're married filing jointly, you can shelter up to $48,000 of gain and not take any taxation on it.
Wow.
If you have 48 to 300, it's 15% cap gain in 2025.
Are you doing the single?
Married. I'm doing married filing jointly. I'm thinking that a single person's not going to get into this by themselves. I'm thinking of our example of being married and filing jointly. So you can shelter quite a bit and lower that taxes if it makes sense. Again, if you're borrowing money, you got to factor into it. So what kind of comments do you have on the flip, Craig?
Well, we had a good time. I just basically provided the money and she conducted the entire program. So it worked out really good, and the people loved it, and they've sold it and made money on it too. So we left some money on the table. But it's a good endeavor. But like I said to begin with, make sure you know what you know. You know that you've done the comps on the property. You bought it under value, because when you put your extra money into that, yes, that's an expense you'll be able to reduce your sale price by. But at the end of the day, you're going to pay some taxes on this gain. So you've got to factor all of these things that she said, the cost of labor, the cost of taxes. There'll be some permits and things that you have to pull. That'll be a frustrating event. And then get this thing done in a reasonable amount of time and make a profit. Just be careful. There are people out there that do this all the time. I know several. They're great at it because they're in that business. Mm-hmm. But if you buy a piece of property, it sits on the ground and you don't improve it and you've borrowed money, you're just paying a payment instead of having positive cash flow. So that's the thing that I'll say about this. It seems really sexy, but at the end of the day, make sure that you're comfortable with being able to do that work.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.